Good morning, and welcome to the June 2022 Drilling and Production Outlook Workshop. I'm John Spears, and I just want to welcome back the folks that have attended these workshops in the past. I've seen some of the names pop up on the waiting list, and so I know you're out there. I just want to thank you for coming back, but I also know that there's some newbies, folks who haven't been at this session before. So just to let you know, what we're going to do for the next hour is review and talk about our updated drilling forecast. The material that I'm presenting has already been sent out to our clients, so hopefully you've received the PDF version of our report, the Excel files with lots of numbers in them contained in that report. And even this presentation has been sent out as well. If you've not received that, or if there's someone else in your organization that you would like for us to send that information to directly, please let us know. You could reach out to Katie Bewley here at our office, and she'll be happy to add that to the list. Like I said, for the next hour, we're going to be talking about the quarterly update. About 45 minutes or so, I'll be rolling through our slides and talking about the conclusions we've drawn, and then leave 15 minutes or so on the back end for Q&A. If you have any questions, you can certainly use the chat feature here at the podcast, or at this seminar, and send us your questions that way, and we'll get them answered at the back end. I do know that the first question is, where's Richard? So Richard Spears is currently at an airport dealing with a unilaterally rescheduled flight that he had booked. And so he was planning to be here, but was called away so that he could actually get on a plane and go someplace. So we're missing him, although I understand Rich is going to be one of the viewers here and will be participating virtually along with all the rest of us. So like I said, the information's already been distributed, and if you've gone through it, you'll have noticed that at least for the year 2022, there haven't been a lot of changes made to the numbers, the important numbers anyway, rigs, wells, footage, and so forth. And it's kind of interesting to talk about or think about why that has been the case. You know, as a forecaster, I like to break the world into known unknowns and unknown unknowns, or sometimes unknown unknowns get called black swans, I guess, right? And those are events that just happen. No one was expecting them. And if you think back now, over the last two cycles, back in December, at the very last minute, preparing that forecast, the Omicron variant emerged and created a tremendous amount of worry about what was going to happen to economic activity and oil demand, and it completely reset oil prices for a short while. So that was a big unknown that we had to deal with. And then back in March, just last March, of course, was a week before the March forecast came out, was the invasion of Ukraine. And of course, that reset oil prices in the opposite direction, much higher. But again, a fundamental action to sort of redirect expectations for the year. Well, this time around, we haven't had any of those black swans hit us in the last few weeks anyway. And so that has allowed us to focus more on the typical set of questions, the known unknowns that we might can generally consider and trying to evaluate when we're putting together a forecast. So this time around, I thought, in light of this events, that we'd want to begin thinking about next year, 2023, and what activity might look like around the world under various circumstances. Again, that fits well. A lot of clients I know are beginning to update their forecast for next year, and so the timing, I think, to begin to think, at least on a preliminary basis, about the world that we'll be dealing with next year is pretty crucial. And so that's going to be, I think, a large part of what we draw or want to draw the attention to during the forecast today. So off we go with the slide deck that I've sent out. As always, we I think is the slide you see there goes through the end of this year, but it's telling, I think, there's such a wide variety of wide variation, I should say, in the estimates of what oil demand growth is going to look like even in 2022. There's a range of forecasters that we sort of grab data from, and the estimates right now for 2022 demand growth range from 1.9 million barrels a day to 3.4 million barrels a day. Now, I can tell you that that's almost unheard of. Most of the time, demand estimates for the year that you're in vary by no more than 200,000 to 300,000 barrels a day. So this is a pretty wide range, and the issue there is really what will happen to demand going forward in light of the efforts that are being made by central banks around the world to reduce inflation by raising interest rates and trying to slow economic growth. So this, I think, is the crux of the issue that we in the industry are going to be dealing with over the coming year is, will these efforts to try and slow economic growth end up, how much of an impact will that have on oil demand growth? If it's a soft landing like the U.S. Federal Reserve believes it can achieve, what that I think means is that oil demand will continue to grow. The rate of growth will slow down, but it won't go negative. If, on the other hand, it's a hard landing, then we would expect that oil demand could actually fall. And if it falls, then now you run into the situation where oil prices might weaken to some degree going forward, and that would no doubt have an impact on how much activity we would see here in the U.S. and in Canada and around the world. So the question, I guess, that we must consider is how competent these central bankers will be in trying to achieve a soft landing as opposed to a crash, as they fight inflation and try and slow it down. So the soft landing is analogous to a plane landing, but they haven't had to take up the trolley cart, so you can still be sipping your drinks and enjoying your beverages as you land, whereas a hard landing is one where they have to shut down the party, put everything away and buckle your seatbelts. And so that's kind of what we're looking at. Now, our expectation is in the course of this forecast that a soft landing will be achieved, that oil demand will continue to grow somewhat, and that will be enough to support high or sustain the current oil prices that we see. The Energy Information Agency is the source of the numbers that you see on the chart here, and they project that demand will rise about 2% next year to a little over 1.1 million barrels a day. So what's interesting is in the course of making that projection, they have assumed that oil prices will fall to $93 a barrel. So I suspect, I think maybe their estimates of consumption are correct, but that they're off in terms of oil prices. The EIA's assumption regarding oil prices is conditioned on oil inventories beginning to grow. We all know that oil inventories on a global basis are at a very low level right now, and that has been key to why oil prices are high. It's just been a very tight market. But the EIA, in its lights, sees oil inventories beginning to grow, and as those inventories rise, they expect oil prices to come down. So that will be a key part of really where oil prices end up going. As is usually the case in this industry anyway, the status of inventories really sets expectations regarding oil prices, and we've been dealing with low inventories now since the middle of last year, and that's what has allowed oil prices to recover from the $40, $50 price to where they are today. And where inventories might go going forward will be key, continue to be key. Any slowdown in consumption and economic activity and consumption is expected to push a lot of oil back in inventories and cause prices to go down. So it might be that in what we think of as a 1 in 3 chance of a recession over the next 18 months that might push consumption lower, that we end up seeing oil prices then down in the 90-95 range in light of that circumstance. I'll go to the next slide here. The other part that's interesting is where is the production growth coming from? Because I think we're in a situation where in the past when we've seen oil prices fall sharply, as was in the case of 2014 to 2015, for example, what was happening was that the producers of the world were drilling themselves into a supply glut. And there was just a lot of oil sloshing around the markets. Inventories were rising rapidly, and that's why prices fell. Well, I don't think we're going to find the production side recreating that 2014 experience. There will be some growth in oil output, but it's not as much as what was the case back then, and much more in line with what might occur if there's a soft landing in these economies and a small amount of consumption growth next year. So this chart just shows where the EIA expects output to increase both this year and next. 2022 and 2023, the red parts of those bars are the decline in production coming from Russia. But then there's a pretty significant growth in OPEC itself this year, but a much smaller growth in OPEC next year. And the reason for that is, of course, that among the OPEC member nations, it's really only Saudi Arabia and the United Arab Emirates that have much capacity to increase production at this point. So they've grown production, and there was an agreement just yesterday that they would sort of add more barrels than have been expected in the past several months. The target for OPEC Plus to increase production has been around 400,000 barrels a day, and they basically want to raise that number to 600,000 barrels a day in July and August. We'll see if they can get to that level of increase. But once we get past the middle of this year, there's just not going to be much capacity for the OPEC nations to increase output. So that's why the black part of that bar shrinks so dramatically in this chart. The orange part is the U.S. So about 1.3 million barrels a day of increased oil production from all sources here in the U.S. both this year and next is behind the EIA forecast. And our numbers, based on what we see happening on the drilling and production side, in terms of completions, in terms of initial well productivity, falls in line with those numbers. So, and then marginal amounts coming into the market from a few other places around the world, both these years. So, but again, I don't think the risk to oil prices comes from suppliers flooding the market. It's really more of an issue of where will demand, how will demand change? Will it continue to grow, or might it begin to, might the curve bend and begin to come down next year if economic activity slows sharply? Behind that then is our estimate where oil prices go. And as you can see, we're out through the end of 2022 in this particular chart. We have oil prices at $115 a barrel in the second half of this year, which leaves the average for the full year at $109 a barrel, and that's up a cool 60% over what it was last year, around $70 a barrel, if I remember correctly. One of the reasons why the market has tightened over the past 5-6 weeks has been that a couple things have emerged. Most importantly, perhaps, is the realization that Iranian production is not going to increase. So there had been hopes earlier in the year that the negotiations regarding the sanctions that the U.S. had placed on Iran because of its nuclear program were going to be negotiated away, and that, to some degree anyway, more Iranian oil would enter the market. And of course, that was helpful given the conflict in Ukraine and the whole redirection of Russian oil flows and so forth. But the state of those negotiations, as we understand it, has pretty much completely broken down. And so it now looks like sanctions will stay in place. And as a result, Iranian production will not change very much this year. And so those additional barrels that people might have been counting on are probably not going to reappear. And so that has tightened the outlook for the market on its own. And then apart from that, but occurring at about the same time, has been the release of the plan by the European Union as to its intent to wean itself off of Russian oil. So last year, the EU imported on the order of 2.4 million barrels a day from Russia, and it wants to reduce that figure by 90% by the end of this year. So it's going to allow a small amount of Russian oil to enter the EU by pipeline to go to countries like the Czech Republic and Hungary and so forth. But other than that, other nations have said we're going to not buy Russian oil. Well, that sets off a mad scramble, doesn't it, in terms of finding replacements for that oil. And that's already been in a very tight market, like I said, with low inventories. So that uncertainty has helped push prices up pretty sharply over the past, like I said, a month or so. At the start of May, they were just over $100 a barrel, and today they're 115 plus. So a couple of events are acting to lift prices. And that's going to be the case, I think, going forward for the rest of this year, that those questions around where will European supply come from and any further growth in oil demand are just going to keep the market pretty tight and sustain prices at what we think will be $115. And if you look at our numbers for next year, our oil price estimate is that oil prices will remain at $115 in 2023. So again, we're thinking that there will be a small amount of demand growth, soft landings, a small amount of demand growth, and sustained high prices. But again, if there's a crash or if there's a hard landing and a downturn in oil consumption, a $90 to $95 price handle might come about. So what does this mean in terms of crude production? Like I said earlier, we're broadly in line with what the EIA was saying. We look at U.S. crude oil and lease condensate output at averaging 11.9 million barrels a day this year and almost 12.9 million barrels a day next year. So about an 8% growth. Again, we're not quite to the levels that we stood at the end of 2019, pre-pandemic and whatnot. But the industry is slowly but surely beginning to increase output, even as it continues to exhibit the capital discipline on the part of so many operators as to what they'll spend. So I think that then becomes the issue going forward for next year is what kind of production growth will operators in the U.S. and elsewhere, but most importantly in the U.S. perhaps, what kind of production growth will they target for 2023? Because that's going to end up setting the activity levels that they see. So in the past, earlier this year, going into 2022, at least a lot of the publicly traded operators were talking about basing budgets on a $70 to $75 WTI price and trying to achieve sort of mid-single-digit growth production rates. And unsurprisingly, really, they have pretty much held to the capex plans under those assumptions. So we haven't seen but maybe a 5% increase in the capital budgets of the publicly traded oil companies anyway for this year. Unlike past years when capital discipline wasn't an issue, and we often saw a big increase in the second half of the year if oil prices were above expectations. Well, this time around, that's not happened. Last year was indicative that even as oil prices in 2021 went from $40 to $70 over the course of the year, the capex budgets that were established under a $40 oil price stayed in place. There was only about a 1% increase in capital spending above the planned numbers in 2021. And this year we're only seeing about a 5% increase above the planned numbers, even though oil prices have moved from the $70, $75 range where that capex budgets were based on to where they stand today. So I think the question then will become what kind of production growth will operators look for next year. Beyond that point is what kind of oil price estimates might they be comfortable making to support those capital budgets. We're thinking that this mid-single digit kind of growth rate numbers are probably what the publicly traded companies will achieve, since most of the growth in activity this year has actually come from the privates, privately held firms. That's one of the reasons why we're seeing production growth rates above that 5% level both this year and next year. But I think that's in line with what seems to be the feeling among operators and the channel checks we can do in the oil patch. Gas production numbers, of course, are much tied to the outlook for oil production. And here we're looking at gas production growth of about 5% next year. Most of the growth in gas production is coming from associated gas production, because a lot of the big dry gas basin in the Marcellus is pretty much constrained from a pipeline takeaway standpoint. It really can't grow, and it counts for about a third or so of U.S. gas production. So we're not going to see much growth from that very important basin. What's left will be the associated gas from oil-prone basins as being the source of any incremental gas going forward. Of course, the story on the gas side is an interesting one in and of itself. Gas prices have dramatically increased this year, as you're all aware. And a big part of that is a function of what's happening on the LNG export side. Again, all because Europe's trying to redirect its consumption away from Russian gas toward other sources. And so LNG terminals are basically operating at flat out this year and next, and for the next several years after that. Because of these events in the LNG market. There are about 14 FERC-approved LNG export terminals that have not yet started construction, but since it takes somewhere between 3 to 4 years or perhaps longer to get a terminal up and running, there's really not much of an opportunity to expand U.S. LNG exports until around 2025 at this rate. So that's going to affect pricing for gas in the LNG trade as well as here in the U.S., because one of the things what we see happening is gas supply from the U.S. being bid away to Europe at the moment. That's one of the reasons why prices in the U.S., wellhead prices in the U.S. have risen so much. This chart tracks what's been happening to Henry Hub spot price. And as you can see, last year's number averaged somewhere just a touch under $4 an MCF, if I remember correctly. And this year we're going to be around, we're currently at an 8.5 handle for the second half of the year, we think. And next year's, or this year's average is going to be somewhere around $7.35, so up almost double from last year's figure. So the gas market here in the U.S. has really risen, and the reason for that increase, again, is because of the volumes of LNG that are being sent abroad, mostly to Europe. The incremental stuff is mostly going to Europe. The volumes exports are going to be, on the LNG side, are going to be up almost 25% this year. And so what operator or analysts who follow the LNG market are saying is that the export price of LNG in the U.S., which has typically been about a third of what the global LNG price has been, that those numbers are going to converge. The U.S. LNG export price will rise and has risen, and the global LNG price will shrink. So the global prices for LNG now, depending upon where you're going, Europe's about $20 a million BTUs. Asia's about $15 per million BTU. Our LNG export price these days is north of $10 per million BTU, I think closer to 12 actually. So we're beginning to see LNG trade from various sources, places in the world, sort of coalescing, becoming much closer than what they typically have. But as that LNG price for the U.S. gas increases, that pulls up the average price of gas in the U.S. and so that's why we expect, and because the LNG market is going to be very tight for several more years, we think that'll be we'll see elevated gas prices here in the U.S. It's I think instructive to note that as the EU tries to switch off of Russian gas. So Russian gas was the equivalent, the imports by Europe of Russian gas last year were the equivalent to about 150 million tons of LNG. And that would have been about 30% of the global LNG trade. So there's just not that much spare capacity in the LNG liquefaction terminals. There's maybe 5% more liquefaction capacity. So as as Europe suddenly tries to import massive amounts of LNG, that's really put pressure on these prices here. Now, Europe will not end up importing 150 million tons of LNG. Their plan is to accelerate wind and solar, to conserve gas, and so forth. They're extending nuclear plants. There's even been some more coal-fired power come on board. So not all of the Russian gas will be replaced by imported LNG, but just the fact that some part of it is headed toward LNG is really pressuring that market and really pushing prices up. So gas prices in the U.S. are going to stay substantially higher next year, and I think that would be the case even if this whole soft landing, hard landing thing, regardless of what happens there, just because Europe has such intent on replacing the Russian gas, and that's just going to drive the LNG market and by extension gas prices in the U.S. for some time going forward. So here's our estimate for U.S. rig activity. We see rig count now. We bumped it up a little bit. We're around 735 rigs now for the year as a whole, and ending the year above 800. In the past quarterly meeting, we had thought the industry would struggle to get to 800 rigs, and it is laboring mightily to increase rig count, but I think it will get there. And in fact, now our numbers would suggest we'll probably end up with a Q4 average of somewhere around 820, 825 rigs if our numbers are correct here. So we've increased our output for our rig count for next year, for this year, a little bit, and at the moment anyway, our rig count for next year is, on a preliminary basis, we've put rig count in the U.S. next year at 860 rigs. So that's a growth of about 17% over the average for 2022. Like I've said, capital discipline remains in play. It was interesting when we look at the Q1 numbers for U.S. publicly traded operators that they returned stock buybacks and debt retirement figure of about over $10 billion in Q1, and that was almost 80% of what they spent on capex. So a substantial portion of their free cash flow is returning to their financial backers. I do believe that any funding that operators would require for their capital spending programs, that they'll be able to come up with using internally generated funds. So I don't think the industry is really in a state now, or operators as a group are in a state where they're very highly reliant upon outside sources of capital. So that's helpful. Like I said, that then just means that the decision regarding capital spending and rig activity and so forth is how much operators choose to try and grow their oil and gas production. If in a situation next year when commodity prices might be flat for all the reasons we've talked about, and oil field inflation is rising around 20% year over year. So that's our outlook for what we think the increase in well costs will be in 2023. And so this will become a problem. How much will operators want to grow production when the cost of achieving that growth continues to rise? So this will be key to setting the tone, and in fact is the reason why we think the rate of growth in activity will slow down. So once we get to the end of this year and we're running somewhere in this 820 or so rig range, our average for next year is 860 rigs. So you can see we've assumed that operators will sort of roll over budgets at activity levels near the current level and end up shooting for something on the order of this 7-8% increase in production but not more than that next year. So we also now have begun to track, and we've done this for a couple quarters now, where in the past we've always talked about new wells drilled. Now we talk separately about well spuds, which occur at the start of drilling, and separately again, well completions, which are when a well is hooked up and put into production. So both are new wells, but one is a measurement of activity taking place at the start of the process, and one is a measurement of activity taking place at the end. And we do that because we know that many of our clients have different interests. Some are much more tied to the drilling process and when it begins, and some are more tied to the completion process. And so we want to be clear as to what's going on in both data series, because last year and this year, again, are showing us that they can diverge. Last year, they were diverging because we were completing a lot of drilled but uncompleted wells. And so rig activity, while it was growing, didn't grow nearly as much as what was happening on the completion side, which was driven by this drawdown in the uncompleted well category. So the two can move in separately in different fashions, and we want to pay attention to that, because we think going forward that the count of drilled but uncompleted wells will begin to rise again. We think we're at a point now where it's about to inflect and begin going up, and that just means that drilling and completion activity will be on slightly different tracks going forward as the DUC count begins to rebuild. So the good news is, one of the things we've worried about in the past is what's happening to the capacity of the service sector to support an increase in activity, because we all know that the supply chain, whether you're talking about labor or materials like frac sand or equipment like rigs and frac units, have been really tight. And many service firms have really been constrained about taking aggressive actions because their working capital was already spoken for. So we're beginning to hear stories that the working capital situation for some of these service firms is beginning to improve, that credit lines are being raised, that cash balances are growing because of prepayments from operators or improved profitability. And so that's allowing them a little bit more elbow room when it comes to bringing new equipment, expanding their service capacity, as it were. And so that's just beginning to happen. And so this is information that's dangerously in the category of what I call anecdata. So it's a little bit of data, but it's not such an extensive data set that it's really solidly. So it's that borderline between anecdote and data that we're at now with regard to this assessment of the financial status of oil service firms. But it is beginning to improve. And that's one of the reasons why we've raised our second half activity level estimates a little bit in according with those kind of trends. Frac jobs, again, is one that we've bumped up the numbers a little bit. Like I said here on the chart, almost 11,700 frac jobs in 2022. And frac activity ending up with spread counts in excess of 300 by the end of the year. Somewhere at these numbers would suggest 310 to 320 frac crews active by the end of this year. We'll see how well that goes. But again, one of the things that has come out of the conference calls among many of the bigger frac service firms is that they're not really going to add much in the way of frac spread count over the balance of this year. So with some of these bigger firms standing pat with regard to their level of activity, that really constrains how much growth the overall sector can achieve in terms of adding frac crews out into the field. So we're still pretty cautious there, but again, it just speaks to the difference in what's going on in the two sectors. So again, we have rig activity continuing to rise through the end of the year, but frac service activity measured by wells or frac jobs or crews, fairly flat. And I think it's important to remember that both sectors have slightly different contracting strategies. So many rigs go to work only once an operator has signed a 2 or 3 year agreement to keep that rig in place. So the rig drilling contractors have been able to achieve that kind of contract status with operators, and have done so now for quite some time. So that means that those plans for rigs tend to be fulfilled. The frac service firms, for the most part, don't have that similar kind of 2 to 3 year contract in place with operators. They're still pretty much working on short-term contracts that roll over pretty frequently once a well pad is done or a series of well pads might be done. So that means that that frac service firms have not quite as much visibility in terms of their long-term revenues, and I think that's making them cautious about how much equipment they want to add going forward. So the contract status or the nature of contracts that rig owners have and frac service crews have is slightly different, and I think that contributes to the sort of the different pattern that we see emerging in terms of capacity expansion in both those sectors. Like I said earlier, we're looking at sustained price inflation for the cost of getting new wells drilled and completed. By our estimates, we'll see from the end of last year to the end of this year that around a 22% increase in U.S. well costs on average, and next year our number is a 20% increase. So we've got a pretty sustained push behind these numbers. Again, reflecting the higher cost of operation and the desire to improve profitability by many of the service firms. Canada has, again, a neat thing going on. Rig activity is up pretty substantially this year. Our Q1 numbers that we had forecast were spot on, but the second quarter has come in at a little over 100 active rigs, and that's been about 20% or so higher than what we'd had expected. Q2 has always been a tough one because you have a lot of seasonal effects, mud season and whatnot, that can affect activity. So that is why we've increased our rig numbers and our well numbers and so forth in Canada. But we've left sort of the Q4 numbers pretty much the same as we had. Now, for 2023, we see that activity in Canada will grow, we think, now about 20% and end up averaging just over 200 active rigs. So we see a decent increase in Canadian activity. Again, operators there remain very capital disciplined, just like their U.S. counterparts. But the higher revenues are going to support and we think lead to a higher level of activity in 2023 up north of the border. It'll be interesting to note, I've got here on the slide here, the Impact Assessment Act, which is, I think, been in place since 2019 and has been used to assess the infrastructure projects. It was recently declared unconstitutional. I'm sure it will go into appeal, and so we'll see if where that act goes, but that could presumably allow a little bit more discretion on the part of provinces like Alberta and Saskatchewan to push development in their oil and gas sectors. So up to this point, the IAA has kind of constrained what actions provinces might take in support of their local economies or their local industries, and so this could be an important change to the feel of things north of the border, but I'm sure it'll be slow to emerge, as are all things in the legal world. We turn to international then for those who have an interest in what's happening outside the U.S. International for us, and these numbers correspond to how Baker Hughes counts rigs abroad, so they don't include counts for Russia, China, and Central Asia, and so those areas are not included in these slides. I've got some numbers separate for those areas, but what we see happening in the international market is that activity will grow around 12% this year. The numbers decline in Q2. You can detect that on this chart, and that's strictly because of the loss of about 30 rigs from the Ukraine. They would have been running around 40 rigs before the invasion. A lot of the rigs got idled, and so subtracting those from the count is why the numbers drop a little bit in Q2. But if you sort of exclude the Ukraine from the data series, what you see is that last year and this year, the international sector, broadly speaking, is growing at about a 15% year-over-year clip. and that's happening in 2022. Now, next year we have our rig count numbers growing up about 9%. So we end up around 864, 865 international rigs. So the rate of growth begins to slide a little bit, but still remains pretty good for what is typically seen in the international market. We have offshore rig count has begun to grow as well, and it's interesting that market is tightening up as you begin to see signs like day rates rising. Rig sales are beginning to happen. Rig reactivations are certainly taking place. Most of the rig reactivations and day rate improvements are among jackups, interestingly enough, and drill ships. So the semi-sub category hasn't really gone very well gone very much in one direction or the other over the past 12 months. But these other categories are beginning to see some play. So jackup work would be fairly shallow water, probably development projects for the most part. But the drill ship stuff is going to be deep water driven. And so that tells us that exploration and certainly development deep water is beginning to pick up for these big projects in a lot of places around the world. When we break the market down, so it's a 12% growth overall internationally this year, but the region by region changes swing pretty dramatically. So Central and South America leads the way. It's been up, or we think it'll be up around 22% this year. You can see with almost 170 active rigs and 2,200 wells. The highlight news in that region to me was the fact that Petrobras has gone to the market with its largest high-spec rig tender since 2019. So says something about the availability of capital and certainly the prospects in that particular market. And so we began to see some movement taking place finally in offshore Brazil. Europe down 23%. Again, that's only because Ukraine numbers are now out of that tally. But it had been hoped that with the European Union trying to wean itself off of Russian crude and gas, that might sort of improve the prospects for North Sea properties. And certainly we see the Norway, for example, expecting to increase its oil production 250, 300,000 barrels a day next year. But not happening on the UK side. And in fact, the news from just this past week really was that the government in the UK plans to introduce a multi-year windfall profits tax to raise money to help people deal with the high cost of living. But be that as it may, it's likely to push UK operators to rethink some of their planned investment, both for exploration and development. So just in the last few days, there have been increasing questions around sort of what might the future be for activity in the UKCS, and so something we'll have to all want to keep an eye on. Africa up about 26% this year. Interestingly enough, it is pretty well positioned when you think about where the Europe might go to get the barrels of oil and gas that it needs. It's close by. There are some highly prospective fields. Many of the European-based companies like Total Energies, Equinor, ENI, BP, Shell, all have large exposure to different parts of the African market. So they're already in place, as it would be, to bring on the barrels that that the European market might need. So I think that's beginning to, and is in part one of the reason why we see, some optimism around the recovery going forward in the African market. Middle East, of course, has been rebuilding since the decline, back in 2020 and early days of 2021. So it's recovering up about 12%, we think, this year, around 275 active rigs, almost 2,500 new wells. Again, the big player there is Aramco, and it now says that it plans to increase its oil-related capex by 25 to almost 50% this year. because it's now embarking on a program to lift its oil production capacity by 1 million barrels a day, moving from 12 million barrels a day that it claims it has now to 13 million barrels a day by the year 2027. So it's like turning around the Titanic. They have to put a lot of dollars to work in order to achieve that kind of a production increase. But that is now the intent in Aramco, even as much of their excess profits are being redirected to other parts of the economy. Still, the oil sector is going to claim a fair share and should begin to support higher levels of activity going forward. And finally, we get to the Asia-Pacific market. So everything from Pakistan east is in that area, and it's up about 8% this year. Much of the activity has been directed toward gas field development. The big player in the market in terms of rig activity is India. What's interesting that happened in India over the past quarter is that the state-owned oil company ONGC has decided it wants to seek international partners to help explore and develop its offshore fields, and also help them achieve this net zero emissions target that they have. So they have generally been one that has acted independent of foreign partners, but that prohibition is being relaxed, or that kind of policy is being relaxed, and so it'll be interesting then to see, will foreign companies chase these opportunities that might occur offshore India over the next several years. And then, like I said, we spent a little time trying to track down activity, China, Russia, Central Asia. You can see the numbers on the chart. High LNG prices has caused China to actually cut back its imports of LNG, although it's going to end up with a lot of Russian gas by pipeline before it's all said and done. It's actually using more coal in place of imported gas for power production from a cost-saving standpoint. But from a field activity standpoint, I think the interesting thing is that PetroChina is going to focus on developing its shale oil production capacity. It's been one that has tended to focus on shale gas, but shale oil is now coming up to the top of the table, at least for PetroChina. Russia, of course, nobody's doing business there now, but as a matter of interest, we expect that activity in Russia will probably not be changed this year, but will probably fall about 10% next year. It's interesting that during the pandemic years, Russian field activity didn't fall in 2020, even though oil output was down, but then fell about 11% in 2021, sort of as a delayed response to the drop in production that they had seen in the prior year. So I think that same kind of pattern will probably be the case in Russia again. And Central Asia, it's just a challenge there. So many of these economies are really tied to Russia, both from the standpoint as a trade partner, as well as the fact that a lot of these countries have their people working in Russia and then sending remittances back home, and that really helps sustain economic activity in places like Kazakhstan and Turkmenistan and whatnot. And so obviously with the Russian economy slowing down, that's impacting, by extension, the economy in these other Central Asian nations. And so they've got a challenge going forward from the standpoint of what their state-owned oil companies can do in terms of financing field and development. So we don't see much change happening there. We think about up 5%, but they're not really in a position for a variety of reasons to take advantage of higher oil prices. So with that, I have come to the end of my slide deck. question that came in was, with 22 ending at around 850 rigs and 2023 averaging around 860, do you see a downward trend in 2023? So that's a good question. Our numbers basically show activity flattening out in 2023 and not really trending down. And that's because our oil price assumption holds steady throughout 2023. So as long as oil prices were in this $115 range and they stay there, then rig activity steadies out itself. And that's just the nature of the model that we use right now for the U.S. market, or the models we use for the U.S. market. But clearly, with costs continuing to increase, as that happens, that begins to take some of the juice out of operator interest in growing production, doesn't it? They've got to they think about it. Most operators hedge about 50% of their production. And so these days, with the spot market rising, these hedges get replaced with ever higher hedges. But once oil prices begin to flatten out, which is what the central banks of the world would like to see, right? Then these hedges, as they roll over, they also begin to flatten out. And if you're then thinking, well, I'm getting the same amount of dollars per barrel for my oil, but now my cost are rising 20% or so, now the margins are beginning to get thinner. Now, I suspect that for a lot of operators, think the publicly traded right now, right? They're plowing back maybe 40% of their free cash flow at the moment, historically low levels. They are returning about, let's say, 30% of their free cash flow to either retire debt or stock buybacks. So that gets them to about 30% of their free cash flow, which is basically ends up on the balance sheet. So they've got some room to accept higher prices, to tolerate higher prices, because there's some margin left in how they're distributing their free cash flow these days. But that game can only go on so long, and then it would begin to affect activity. So I suspect as that begins to happen, that you see inflation in the oil patch drop significantly. And so ultimately, if oil price year-over-year inflation gets to the point where it's about 0% growth, if oil prices are not growing year-over-year, oil field inflation will at some point also look like it only changes about 0% year-over-year. So I think longer term, that's kind of where that goes. Another question, interesting, that come in is, as gas prices increase because of LNG trade, how does this affect U.S. gas prices for home consumption this coming winter? Are we to expect high heating prices? And the answer there is yes. And here's the interesting thing about that, is that in the past, when U.S. like Henry Hub prices rose, then what would happen is that the power sector would switch from using gas back to using coal. Certainly this year we've seen gas prices skyrocket, as you saw in the charts. But we have not seen the power sector switch back to using coal. And I think the reason, its consumption of gas actually has grown. So this has broken a multi-year trend in this oscillation between high gas prices and coal use. And I suspect the reason is that many power companies and many utilities have retired a lot of their old coal-fired power plants, and so they don't have the same amount of operational flexibility about switching back and forth between gas and coal to get to whatever the lower cost element. They don't have that same operational flexibility that they used to have, so they're sort of stuck with continuing to use significant amounts of gas. So to the question, yeah, I think they'll pass through these higher gas prices as to whoever their customers are, be that industry or the residential commercial sector. The first slide, let's see if I read this right, slows oil supply and demand in equilibrium in Q2 and Q3 of this year. Why are oil and gas prices at peaks? Well, again, the demand supply numbers are pretty close together, but inventories are very low. In fact, they're like well below normal given the consumption levels. And so because inventories are so tight, that has been the signal to oil traders to bid up the price of oil. the market needs to add a substantial amount of capacity to commercial oil inventories in order to sort of drop prices back to the normal level. If prices were at a normal level, history would tell us that oil prices would probably, WTI prices would be around $80 a barrel. So that tells you something about the, with prices at almost 50% higher than that today, that tells you something about how much these low inventories are impacting pricing. And what's kind of interesting is that the release of strategic petroleum reserve crude, 180 barrels from the U.S., another 180 million barrels from the U.S., 60 million barrels from other sources. Much of that crude, I think, is really going to just sort of turn around and go back into commercial oil inventories and kind of help alleviate some of the low numbers there, but not so much that it materially impacts prices. If you remember correctly, when those announcements were made, that the price of oil came down $2-3 a barrel, but that was back when oil prices were $90 a barrel, and they're much higher now. So, oh, okay. Yeah, Charlie's telling me I need to reprise the first question, which was the discussion about high-spec rigs and rig new builds. So we have rig activity through the end of this year. We've increased our estimate. We had been talking that, man, it's going to be hard to get rig activity above 800 rigs just because of the limitations on rig availability that we see in the marketplace. But now we've raised those numbers a little bit, but it's not because we think new builds are taking place. And in fact, if you were to try and build a new rig today, it would take you about 80 weeks to get the engines you would need from Caterpillar to power that unit. So that's a year and a half, right? So that takes you to the end of 2023. And then with everything else, it's probably mid-2024, almost 2 years out before you would actually see any new build rigs enter the field. So the fact that rig activity we think can go above 800 is really just speaks to the fact that drilling contractors are cobbling rigs together. Some operators are choosing to go to work even though they aren't getting their hands on a high spec rig, but they're getting something close to that. So that's helping push rig activity a little bit higher than what we had previously forecast. And the other thing too is just that drilling contractors are beginning to see some relief in their working capital constraints, and that's allowing them to spend money that they need to spend in order to reactivate rigs. So all that is part of why we think that rig activity will end up being a little bit higher than what we had been forecasting when we put together our numbers 3 months ago. And I think that's about all the time we have, right? So I'll sign off for today. Always feel free that after this session and anytime before our next session in September, if you've got questions that can be handled by email, please do so. If you want us to jump on a chat with your team as they think about what might happen next year, we're also glad to do that too. So don't be shy. Always glad to work in that fashion. You can either reach me directly or through Katie Bewley or Richard Spears if he ever gets back from his trip. So for now, I'll sign off and look forward to seeing you again in September. Take care.